Okay, I'm going to go over my fundamental analysis of Scott's Miracle-Gro and show you why I think this stock is heavily undervalued, a very deep discount value stock. And I was probably looking at going to over $100, probably in my price target, $120 to $150 in the next several years. So first, I always generally like to get an idea of what the chart looks like. Where's the stock relatively to the past? Because this can kind of tell us, well, what's the price now compared to what it was in the past and what were the fundamentals in the past. So I've already looked at this stock and I've traded generally what I feel is their long-term growth trend. And as you can see here, if we look at 1 year, it's about 6% a year, which is quite reasonable. And right now we're pretty low in the trend. And in fact, Scott's Miracle-Gro has had its biggest crash in history. It's even bigger than the 2008 crash. So this has been a really, really big crash. But on the other hand, it did get way, way ahead of itself. Okay, so let's dive into the financials now. So here we are in Guru Focus. One of the first things I like to do in the financials, I'll just kind of go through them how I like to look, is I like to look at the return on invested capital and the weighted average cost of capital. This kind of just tells me what's the growth trajectory of the company. Is the company still in the growth mode? And we can see it's 20 years here. Even in the last, like since 2008, we got a nice high ROIC, above 10%, sometimes bumping up to 14. Here's our unusual amount to 17 from when things went really, really crazy. And because they started making some losses in the last year, well, it's a little bit lower, but we're probably going to revert back to somewhere there. And in comparison to their weighted average cost of capital, if you don't want to be destroying value, you want to have your return on invested capital above your weighted average cost of capital. We can see our weighted average cost of capital is quite below our return on invested capital. So this company has been growing pretty steadily at a very nice tick. And, that's kind of what you see in the chart here is, gone on along the way there and, steady growth. Not crazy growth, but, some steady growth along the way. And if we can get it at a really big discount, we can get outsized growth. Now, let's look at the revenue. As you can see, the last 20 years, revenue's been slowly ticking up. When 2008 hit, it did slow things down. As you can see, it peaked here just under about $3 billion, dollars, and then it kind of actually contracted a little bit even in 2015, 2016. But the interesting thing is the price now is similar to what we were all in this past here. So we're trading as if things are maybe like if things were fair valued back in 2012, 2013, 2014, we're trading at that same price right now. And then you can see things were a little bit flat. Then they started to pick up in 2019, really picked up in 2020 and 2021, I guess, when everyone's given stimulus money and stays home, they all work on their lawns. And there's also the whole marijuana industry, which is, I think also got a lot of their business. But that kind of sugar high for the stock of revenue growth wore off. Very similar to what happened in 2009 there. And we've contracted back down to this 3.9 billion from a high of 4.9 billion. Like very clearly going from 4.1 to 4.9 just after coming off 3.1 is not sustainable growth. And we can also see in the last year the gross margin has got incredibly hit. This is likely due to inflation and other cost structures because when your business goes from 3.1 to 4.9 billion, you need there's a lot of infrastructure and staff that you're building out and this and that, and you just don't need it now. So you're going to have a lot of redundancies, and I'm going to get into later that's the bullish case in this stock is they're trying to fix it up and reduce all those expenses. And then you can see the operating income here slowly ticking up. It was, declines a little bit, but in these years here, even compared to the revenue is the same back here, they were able to get a little bit more efficient and the operating margin increased. So as you can see, the operating margin was getting into these teen percentages here. And that somewhere in that range, we're probably looking at seeing this stock going forward. And also over the years, they started taking on a little bit of debt. It's not a huge amount, 118 million in interest expense. When you're doing 2021, 726 million, this is getting a little higher than I would like it, but a lot of that's because they've been losing money, so they've taken a lot of extra debt, and hopefully they're going to be able to start paying that back in the future. So we continue going down the income statement here, and then you can see also net margin kind of, telling us the same story as the operating margin there. And our EPS here, steadily ticking up. And we had a really, really big surge. Then they had some big losses. That's why they've had taken a little bit more debt. But hopefully, we're going to be reverting back to a good number. I think they're looking at, I'll get to this later, but probably it's like the $5-6 range in the next several years. And for shares outstanding, they've been a very profitable company in the past. They've been buying back shares quite consistently. So this company overall has been pretty good. They have their hiccups every once in a while. Hopefully this hiccup here is they're going to get over it. And if they do, the stock probably has a very good outlook going forward. So next thing, checking out the balance sheet, we got just under $2 billion in current assets, and the total current liabilities is under $1 billion. So this is good because even though they're losing money right now, even though they're actually expecting to make some money going forward, they actually still can sustain some losses because the current assets are so much higher than their current liabilities. But this also gets into another issue, as you can see their inventories have completely exploded. Their inventories from 2019, 540 million to 1.34 billion. They thought this growth trend was going to maintain, and they got way ahead of themselves. And as we know, it did not maintain. And this is what the overall macroeconomic things is. Everyone, is buying up inventory, creating these shortages in the last year and the year before, and then suddenly that growth's not there anymore, that very unusual high growth, and now they're stuck with all this inventory. And you can actually go up and just look at some of these other ratios here. Where are they? Of inventory turnover. So you can see the inventory turnover here, how poor it's gotten. It's severely deteriorated because they're not turning over the inventory very quick to how much inventory they actually have. Okay, so we go down the balance sheet a little bit more. I like looking at what are their assets at. We got 4.3 billion in total assets. 254 million is goodwill, which doesn't count as anything. So really about at 4 billion there, and the total liabilities is just around that. So most companies do this. They like to have the assets and liabilities kind of match up. It's fairly normal. We just know that we don't have a big cushion sitting in the stock because of a big cash balance or the ability to take a lot more debt because, well, they're already somewhat leveraged with the amount of debt. And we can see in their long-term debt here, over the last few years, they did take a lot more debt. Even actually when they were doing well, they was actually boosting up. And especially in the last year when things weren't going so well for them, that's when they really packed on a lot of that debt. So hopefully they're going to be able to start paying that down in the future. So we don't have any shareholders equity because of this, but that's fine. It just has to go into our overall value of the stock. So we get to the cash flow. We can see cash flow from operations. We had a little loss. The one thing I did forget to go over, let's bump back up to the statement here. Even though they're making these losses, this is a one-time expense of 643 million. So in reality, where they are losing some money, a lot of these losses, at least 642 million of it, is not actually as bad as you think, since this is not going to be a likely recurring ongoing expense. Okay, back to the cash flow. We can see how have they been growing their business. Well, they're just growing a lot of it naturally by purchase of property, plant, and equipment. Pretty steady. It's been increasing a little bit. And in the last decade, they've started more going into purchasing other businesses and doing some acquisitions. They also do some sales. So there's a little bit of churn going here, but it's not actually like a huge amount. And as companies grow and they run out of the ability to kind of just grow naturally on their own, it's pretty natural to buy other businesses. And this is why we want them to have a good return on invested capital, since it tells us that when they're purchasing these businesses and growing their own business, we're getting a return on it and we're not just spinning our wheels, wasting money. And you can see they've also been repurchasing a lot of stock over the year too. That's why some of their money's going, so they're returning the capital to shareholders. It's going down. They've stopped it recently, probably good because they're not making any money, but this is the one big problem with share buybacks in general, is it's easy to buy back shares when things are good, but when things aren't good and your stock's really cheap, well, you don't have the money to buy back shares anymore. So that's one of the things I would like to see in ScottsMiracle-Gro, or I like to look at other companies, is when they have very healthy balance sheets, a lot of equity in a company, they're sitting on the cash, because then they can continue to deploy that money into share buybacks, for example, when the stock's cheap. We can also see that their net issuance of debt here, and this is the last few years. You can see it's about like 1.5 billion. Basically, they've some payments of debt, issued new debt, and that's why their interest expense has popped up. In the past, they have had years where they've net paid it down, so we're hoping if things are good going forward, they're going to be able to pay that down going forward. And other interesting thing here is when we look at the number of employees. You see, before they were always hovering around, when they were really making some good money, around this 5,000 employees, and then when the business really boomed, they boosted up to 7,300. And this is a lot of this expensive overhead that's adding to their current losses and what they actually need to trim down. I even have it brought it up over here, and they've already started doing the layoffs. They hired into a company that they think they're going to be doing 5 billion plus, and you're back doing around 4 billion. You've overhired. You need to get rid of those people. So you can see here articles from January, August again, November. It's like they're doing cost cutting. They're going to be laying off people. They're going to be making their plans more efficient. And that's where we can go into their financial statements here that they released, or their press release. And you can see ScottsMiracle-Gro, full years and earnings in line with guidance, launches phase 2 of Project Springboard to realize further cost savings. And this is where a lot of companies are going right now. They want to really cut down those costs. And you can see they're already achieved $100 million of analyzed, and they want to do more. And they're reaffirming their projection of $1 billion in free cash flow over the next 2 years. So maybe this is going to be 400 million in 1 year, and then 600 million in the next year. Either way, these are actually really big numbers. So even though they're having all these problems now, they're actually expecting things to go quite well in the future. And if we go just get an idea what their free cash flow was in the future here in the past, you can see this is above and beyond what they were doing in the past. And even if we're compare the free cash flow to the net income here, again, this is at the upper range. They're expecting that even though their sales have contracted, they're going to make their business more efficient, much like they did in this time here. And their net margins started going up. They started cost cutting, even though the business wasn't actually increasing in the revenues. As you can see, the revenues are quite flat, but they did this very efficient cost cutting. And this is what they're trying to do now and what they're going to do going forward. So another thing I like to look at is the dividend, because this stock is paying a good dividend right now. So we're going to go over to the dividend tab here. And they've had no dividend reduction since 2005. And right now they're almost yielding 5%, which is pretty good. And if we look at historically how much they've yielded, it's, we're pretty much coming off the highest dividend yield ever. But then we also have to look at, well, can they actually afford this dividend yield? Can they afford these payouts? So let's go back to our income statement here and financial statements. We need to pop down to the cash flow. And where are we? Cash flow from dividends. So you can see here 166 million, this 37 million a quarter. It seems pretty maintainable for if you're going to be doing $1 billion over the next 2 years in free cash flow. You can afford to pay out 166 million a quarter. And even if they continue having a little bit of short-term headwinds, because they have all those current assets over the current liabilities, they're probably not going to want to cut the dividend, and they're probably going to keep paying it out because this isn't overly burdensome for them. So let's go to the next thing, and I like to look at the financials on a nice interactive chart here. This also gives us our forward revenue estimates, so we can see what the analysts are generally looking at and kind of a collaboration. So you can kind of see in the past how the revenue has gone, which we already looked at, goes up, has a little plateau, and then goes back up. We had a little peak. We're come back down, and they're expecting it to generally increase. Are we going to increase? Is it going to stay flat? Who really knows? This is what the market's pricing in right now. And let's also get the EPS with estimate, because really what matters is the earnings. And you can see the earnings here has been, even though the revenue had declined, we saw these cost efficiencies in the past, and the earnings was on a little steady increase. You have little dips and dives, but it's generally going up, got way ahead of itself, and they're kind of expecting it to go back into the mean of this long-term trend, which that really does make a lot of sense. So I also like to look at a lot of these things of like if the net margin is going to be the same, how is it going to be? How is the prices relatively to what it was in the past and the future? So let's pop up the historical price to sales ratio. So look at the price to sales, and we're way down in the pits right now. We're coming off an equivalent price to sales ratio as near the bottom of 2008. So if Scott's Miracle-Gro can get their net margins back to their historical averages, let's bring up the net margin here. This is just taking all the data and the financials from the financial statements so we can just visually look at it. If we get back to somewhere in this range here where it's just kind of normalized, we're getting some net margin, and we're not way down here in this, I guess 6% here, 7%, somewhere around there. There was a few odd bursts up, but then sometimes there's a counterbalance with below average. But if we just get back to this mean net margin, our price to sales ratio is telling us we're extremely undervalued right now, very similar to 2008. And when we look at the 2012, 2013, if this was a time when the stock was more fairly valued, or even here, we could be looking at a price to sales ratio of 1.3, 1.4, and that can garner a lot higher price. And if net margin improves like it was on that overall trend of improving, and we start getting price to sales ratios closer to 2, we're talking about the current value is maybe even closer right now to $80 to $100, and with a little growth, this is one of the reasons why I think it can very easily grow into that $120 to $150 range. And let's now pop up the P ratio. One thing people like to do is look at the PE. Let's see what the PE has been in the past. And people sometimes have very low expectations for PE. They want to be everything super cheap. I'm just gonna get rid of the revenue here. And this is obviously when they start losing money and have a little off year, they lose a lot. But you can see going forward here, 18, 15, this was at the depths of the 2000, after 2008, 2009, gets into the 20s. And it looks like in this time here, when the business is going well, they justify a mid-low 20s. Once they get a little bit higher, that's usually when they come down a little bit. And low 20s, mid 20s, it's a reasonable price to earnings ratio. And even in here, it got a little bit ahead of itself too. We had that big boost in revenue, running up to those higher levels, and then as the income crashed down, it's gone. So when we take this all together, and we're looking at, let's actually just go back here and bring up the EPS estimates, because I was talking about earlier, and we're talking 2025, $6.19 what the estimates are, which makes a lot of sense where it is. And when we apply a PE to that, the 619 times a 22 PE is putting us right in that $120 to $150 range, $136. So unless things get dramatically worse and Scott's Miracle-Gro has to significantly decrease their estimations, which they currently have with a price forecast of $1 billion in free cash flow over the next few years, it does look actually very practical that this company can get back to the $100 price range. I'm looking up to potentially $150. Along the way, I usually like to, take some profits and sell it along the way. So I'm not just holding it for the whole 150. And I already have a position in Scott's Miracle-Gro. I got a little bit back here at about 47 bucks and change. So it's a little bit up. It's not a huge position yet, several hundred shares. I would like the stock to pull back at some point in the future. And I'm looking at anything under 50 to really adding, because even just if they perform under the expectations of 1 billion over the next 2 years in free cash flow and 800 million, they can still justify them very easily in the $80 to $100 price range, which is a significant gain from now. So tell me what your thoughts. What do you think of Scott's Miracle-Gro? Are you interested in buying them? I'm not telling you to buy them. I'm just long myself. This is how I like to look at stocks. But I think if you do your research, you want to dive in, make sure all this makes sense to you. But this is a company I'm happy just putting my money in and waiting till it gets up there. I don't know how fast it's going to happen. It could just zoom straight up and get to it and, I'll sell it. Or it can dawdle along. Maybe it's going to be slow if there's the economic conditions are a lot worse than expected. It might take years to go up. But when we're looking at potentially, 200% return, like, 3 times gain in the stock there, you have some time. You have time on your side. You can wait 3-5 years and still get extremely strong returns. So I hope you like this analysis and my thoughts on Scott's Miracle-Gro. Remember to like, share, and subscribe, and I'll see you in the next video.